Imagine you are looking at a master dashboard for your business, right? You're trying to plan out your budget for the next year or two.
Yeah, the classic forecasting headache.
Exactly. And you glance at the left side of the screen, and the dials are telling you that energy is cheaper, more stable, and, more abundant than it has been in a decade.
Green lights across the board.
Right, green lights everywhere. But then you look at the right side of the screen, and those dials are just flashing red, essentially screaming that your local power grid is about to buckle under a 105-degree heat wave.
Which is terrifying when you're trying to lock in costs.
It really is. So which dial do you trust? I mean, how do you buy your power when the market is literally telling you two completely contradictory stories at the exact same time?
Well, that is the defining challenge of mid-August 2026. I mean, we usually find comfort in clear cause and effect relationships in economics, right?
Sure. Abundant raw materials should mean cheap, reliable end products.
Exactly. But right now, we are looking at this profoundly fractured market where those fundamental laws they seem to be entirely suspended.
And that is our mission for you today. Welcome to the deep dive. We are taking a magnifying glass to the August 17th, 2026 GWT2Energy Weekly Energy Market Watch and Procurement Buying Guide.
It's a dense report this week.
It really is. We are going to decode exactly why the commodity and power markets are behaving like this, the physical realities driving the chaos, and most importantly, how you can navigate it for your own business portfolio.
Because the underlying theme here is a massive physical and economic contrast. I mean, we're dealing with an almost historic abundance of underlying natural gas in the ground and in storage.
But there's a catch, right?
A massive one. Simultaneously, the actual electricity you pull off the grid to turn your lights on is highly stressed, it's hyper-regional, and it's completely at the mercy of the weather.
So to make sense of this dashboard, we really have to start with the baseline metric, which is the EPI, or the Energy Procurement Index, compiled by GWT2Energy.
Right, the EPI.
Yeah, and think of the EPI like a financial stress test for a company's energy budget, but it's scored kind of like golf.
Oh, coffee. I like that.
Yeah, so it's a scale from 0 to 100, and lower is better. Like a low score means the market is calm, supply is high, and it is a highly favorable environment for you as a buyer to lock in those long-term energy contracts.
While a high score means you are facing extreme volatility, high risk, and you probably want to keep your hands far away from the buying button.
Exactly. So where are we at right now?
Well, for this week, the overall blended EPI is sitting at 47 out of 100, and that is down 1 point from the previous week.
Okay.
So in the context of the scale, 47 puts us right in the moderate or balanced buying window. It is sitting smack in the middle of the spectrum.
Okay, let's unpack this, because a score of 47, it sounds incredibly tame. Like it sounds like a mild Tuesday afternoon where absolutely nothing interesting is happening.
Yeah, it really does.
But when you look under the hood of this overall average, those individual commodity and power markets are sending violently mixed signals to buyers.
Oh, absolutely. The 47 is essentially an illusion of calm. It is just an average of two extreme forces pulling in completely opposite directions.
So breaking that down.
Well, the fuel fundamentals, specifically natural gas, are highly, highly buyer-friendly right now. Like the infrastructure is flooded with supply.
Right.
But the near-term power market, the actual electrons moving through the wires, is hypersensitive to a very specific, aggressive weather pattern we are seeing right now.
So the underlying fuel is cheap, but the physical delivery of the power is incredibly stressed.
Exactly. That's the disconnect.
Let's start with the left side of that dashboard then, the good news side of the index. If
Yeah.
the overall score is 47, the natural gas EPI has actually plummeted down to an incredibly favorable 32 out of 100.
Which is fantastic for buyers.
Yeah, it's firmly in the favorable territory, and the trend is still pointing downward.
What's fascinating here is the sheer physical scale of the supply that's driving that score down. I mean, if we look at the August short-term energy outlook from the EIA.
That's the U.S. Energy Information Administration, right?
Yes, exactly. Their projections for natural gas storage are just staggering. They project we will hit 3,985 billion cubic feet of natural gas in storage by October.
Wait, nearly 4,000 billion cubic feet.
Yeah. It's a massive number.
To even visualize that, you have to imagine essentially hollowing out entire mountain ranges and just filling them with pressurized gas.
That's a great way to picture it. And that is the highest pre-winter inventory we have seen since 2016. Like
Yeah.
we are heading into the colder heating months with the national gas tank effectively overflowing.
Wow.
And, it is not just the static gas sitting in storage caverns. It is the active velocity of what we are pulling out of the ground every day.
The daily production.
Right. The EIA expects that in 2026, U.S. marketed natural gas production will hit a brand new record average of 122.5 billion cubic feet per day.
So we have record daily production directly meeting a 10-year high in storage. But there is a mechanical bottleneck mentioned in the GWT2Energy report, right? Something that is trapping all this gas here in the United States.
Yes, and it involves a facility called Freeport LNG. This is a really crucial piece of the puzzle.
Right, down in Texas.
Exactly. Freeport LNG is a massive export terminal on the Texas coast. Their entire business model is taking domestic natural gas out of our pipelines, chilling it down to hundreds of degrees below zero until it condenses into a liquid.
Which is liquefied natural gas, or LNG.
You got it. And then they pump it onto massive tanker ships to sell to Europe and Asia.
But right now, Freeport is undergoing significant facility maintenance, right? So they are operating at a heavily reduced capacity.
Which means they are not pulling their usual massive daily volume of what we call feed gas from the domestic pipeline network.
Yeah.
The export pipe is effectively clamped shut.
Meaning all that extra gas, which was supposed to be shipped overseas, basically has nowhere to go. So it backs up into our domestic market, flooding the system and driving prices down even further for domestic buyers. I mean, it is a classic oversupply scenario.
Absolutely. That temporary bottleneck is highly advantageous for anyone buying domestic natural gas right now.
Here's where I want to push back on the strategy, though.
Okay, let's hear it.
Put yourself in the shoes of the business owner listening to this.
No.
You are hearing that domestic production is at an all-time record high. You're hearing storage is the highest it has been in a decade.
Right.
And you are hearing that a major export terminal is offline, trapping even more gas in the country. If I am looking at that data, my instinct is to just hold off completely.
Right. Wait for the bottom.
Exactly. Why would I lock in a contract today at a score of 32 when all the physical mechanics suggest the market is going to keep flooding? Like, why not just wait for the price to hit absolute rock bottom?
Well, it is the most common psychological trap in procurement. You see the downward momentum and you want to catch the very bottom of the curve.
Right, trying to catch a falling knife.
Exactly. But the report cautions strongly against assuming prices will only move lower, because you have to look at the mechanical reality of that Freeport LNG situation.
Because the maintenance won't last forever.
Right. That maintenance is temporary. When that facility and other export terminals currently under construction come fully online, the international demand for our gas is massive.
So the glut disappears.
Very quickly. That domestic glut you are watching right now can evaporate into those tanker ships surprisingly fast. And when it does, the price will snap back aggressively.
So if you don't try to time the absolute bottom, how do you, mathematically speaking, take advantage of a favorable 32 out of 100 EPI score right now?
The report recommends a strategy called layering, particularly in the 6 to 18-month contract horizon.
Layering.
Yeah. Instead of taking your entire gas budget for the next year and locking it all in on one random Tuesday afternoon, you buy it in slices or tranches.
Oh, I see.
Let's say your business needs 100,000 units of gas for the year. You lock in 25,000 units today, capturing these highly favorable rates.
And then you just wait and watch the market.
Right. If the price drops a little more next month because storage hits another record, you lock in another 25,000 units.
Got it. So you are building a protective average. If the export terminals suddenly come back online tomorrow and the price spikes, you already secured half your budget at the floor?
Exactly. So your overall business operations aren't derailed by the sudden market shock.
You capture the value of the current oversupply without betting your entire operating budget on your ability to predict the future.
Precisely. It's about risk management, not fortune-telling.
Well, here's where it gets really interesting, because this brings us to that massive contradiction we opened with.
The electricity side.
Yeah. If natural gas, which is, the primary raw fuel we burn to generate power in this country, is practically overflowing our storage caverns, why isn't the electricity market just as cheap and relaxed?
It's the million-dollar question.
Right. When we flip over to the electricity EPI on the dashboard, the score hasn't dropped. It has actually risen to 62 out of 100, putting it firmly in elevated risk territory.
It seems entirely counterintuitive, right up until you separate the fuel from the delivery mechanism.
Yeah, I was actually trying to visualize this earlier. Imagine you run a massive commercial farm.
Okay, I'm with you.
You have millions of gallons of water sitting in a pristine reservoir. record high water supply. That reservoir is our natural gas storage. But it is the hottest, driest week of the summer. Your crops are dying, so you turn all your irrigation pumps on to maximum capacity at the exact same time.
Oh, I see where this is going.
Right. It doesn't matter how much water is sitting calmly in the reservoir. If the physical pipes carrying the water to the field suddenly heat up, expand, lose pressure, or literally burst from the sheer volume trying to force its way through all at once, you have an agricultural crisis.
Yeah, absolutely.
You have the raw material, but your delivery infrastructure is just buckling.
That is a perfect analogy. You are hitting on the physical limit of the power grid. Having cheap, abundant raw material is totally irrelevant if the mechanical infrastructure converting it into electricity and delivering it to a business is pushed past its operational limits.
And the stressor pushing those limits right now is extreme persistent weather.
Exactly. The report leans heavily on a specific hazard outlook from NOAA, released on August 16th.
And what did NOAA say?
The NOAA outlook is basically the primary engine driving this elevated 62 out of 100 electricity risk. They issued a stark warning for a major long-duration extreme heat period extending deep into late August.
So not just a weekend heat wave.
No, this is not a localized two-day hot squall. This is a massive heat dome covering the central United States and much of the southern tier, and it is just sitting there.
Let's walk through the actual physical mechanics of why a heat wave divorces the price of electricity from the price of cheap natural gas.
Sure.
Because I think a lot of people assume that if the gas used to spin the turbine is cheap, the electricity coming out the other end has to be cheap.
It's a fair assumption. But we have to remember the grid is a fragile physical machine. When you have a massive multi-state heat dome, every single air conditioning unit in the commercial and residential sector kicks on and stays on for days.
Which creates a massive surge in demand.
Right, a massive sustained spike in electricity load. And as all that power tries to move through the transmission lines, the lines themselves physically heat up.
And when metal transmission lines heat up, they actually become less efficient at carrying electrons, right? I read they can even physically sag from the heat.
Yes, they do, which reduces the amount of power you can safely push through them. This creates severe bottlenecks, or what the industry calls congestion.
Okay, congestion.
Now, the grid operators still have to keep the lights on in the cities. If they can't get power from the cheap, efficient natural gas plants because the transmission lines are congested, they have to physically spin up older, dirtier, much less efficient power plants that happen to be located closer to the cities.
Ah, these are often called peaker plants, right? Because they only run during peak demand. And because they are old and inefficient, they are wildly expensive to operate.
It costs an absolute fortune to mobilize them. So during these extreme heat events, you are no longer paying for the cheap natural gas sitting in a cavern in Texas.
You're paying for the emergency.
Right. You are paying surge pricing for the emergency mechanical mobilization of older plants just to keep the grid from collapsing.
Wow. Which means, as a buyer, reacting to those emergency surge prices is a very dangerous game.
Extremely.
And since this electricity risk is tied directly to localized weather and local grid infrastructure, the report actually breaks down the U.S. grid region by region.
It does, which is really helpful.
Let's take a tour to see where these mechanical pain points are the most severe, because we are dealing with different grid managers called independent system operators, or ISOs. Think of an ISO like the air traffic controllers for the power grid in a specific region.
That's a good way to look at it.
Yeah.
And buying power from the air traffic controllers in New York right now is a completely different universe than buying it in Texas.
So let's start right in the crosshairs. ERCOT. That's the operator that manages the grid for almost the entire state of Texas.
The famous ERCOT grid.
Yeah. The EPI for ERCOT is sitting at a heavily elevated 70 out of 100. That is the highest regional weather risk in the country right now.
If we connect this to the bigger picture, ERCOT has a unique structural vulnerability. It is physically isolated.
Right. It's its own island, essentially.
Exactly. Unlike other regions, Texas does not have massive high-capacity connections to neighboring grids. If they run out of power, they cannot easily import emergency electricity from Louisiana or New Mexico.
So you combine that physical isolation with the NOAA outlook, this persistent, geographically broad heat dome sitting directly over the state for weeks.
And it maximizes the probability of those transmission lines congesting, those expensive peaker plants spinning up, and the price is absolutely skyrocketing in real time.
Which explains the 70.
Yes. A 70 out of 100 means you are in a highly volatile defensive posture.
So what should a buyer do? Well, the report explicitly advises buyers in ERCOT to avoid any discretionary buying into this heat-driven strength.
Hmm.
If you have the flexibility to wait, do not lock in your long-term corporate power contract on a day when the headlines are screaming about rolling blackouts and record temperatures in Dallas.
That makes sense. Let's contrast that with MISO, the Mid-Continent Independent System Operator covering the Midwest.
Okay, MISO.
MISO's EPI is sitting at a 51 out of 100. The report actually highlights this as the best relative buying region on the board right now.
It is.
But here is my deduction, and tell me if I'm wrong. MISO covers the central U.S., which means they are also getting pounded by that exact same NOAA heat dome.
That's right.
So why does Texas get a flashing red 70 while the Midwest gets a calm 51 if they're both baking in the sun?
It comes down to geography and interconnected infrastructure. MISO is vast. It stretches all the way from the Canadian border, Manitoba, down through the Midwest, all the way to Louisiana.
Oh, wow. That's a huge footprint.
Because of that massive geographic footprint, their air traffic controllers actually have options. If there's a crushing heat wave in Louisiana, it might be a cool, breezy day up in Minnesota.
Ah, I see.
So MISO can wheel that excess power down through their vast network of connected lines to balance the load.
They aren't isolated like Texas. They can share the burden.
Precisely. However, notice that a 51 is categorized as balanced. It is not low risk. The report makes it very clear that the central heat prevents MISO from getting a true buy signal.
So it's still a bit cautious.
Yes. The strategy there is to be opportunistic. You use market weakness to buy. If a cold front moves in for 2 days and prices dip, you lock in a tranche of coverage.
But you do not chase the rallies.
Exactly. When the heat spikes the price, you step back.
Okay, let's do a quick flyover of the rest of the map. We have PJM, the massive operator covering the East Coast and parts of the Midwest. PJM is sitting at an elevated risk score of 64 out of 100.
Right. PJM has meaningful exposure to this eastern heat. The key advice there is to monitor the peak load days carefully.
So watch the weather reports closely.
Yeah. A short-duration 3-day weather event will spike prices locally, but do not treat that temporary emergency as a reason to panic and lock in your entire annual power position at a massive premium.
Good advice. And finally, we have NYSO in New York at 57, ISO-NE in New England at 58, and CAISO out in California at 53. All three are sitting right in the middle, in balanced or watch territories.
Right. For the West Coast and the Northeast, the summer supply margins are currently expected to hold up. California is always a unique beast, of course.
Because of the solar power?
Yes. They have to carefully manage the evening hours when the sun goes down and their massive solar generation drops off the grid. But there is no broad systemic emergency buying signal out west right now.
And for New York and New England?
The advice is simply to maintain your normal procurement cadences. You watch out for regional basis shifts, but otherwise, stay the course.
Okay, let's clarify that term, basis shift, for a second. Mechanically, what is that?
Think of it like shipping costs. The actual electricity might be cheap where it is generated, say, at a hydro plant upstate.
Oh, okay.
But if the transmission lines getting down into New York City are congested, you have to pay a massive premium to force that power through the bottleneck.
Oh, I get it.
The difference between the cheap generation price and the expensive delivery price is the basis. It's essentially a local traffic jam on the power lines that can cost you a lot of money, even if the overall market seems calm.
So what does this all mean? We've looked at the macro grid conditions, the massive gas storage, the intense heat waves, and the air traffic controllers managing the lines.
It's a lot to process.
It is. Let's get deeply practical. How do you, the listener, actually apply this intelligence to your own business?
That's the most important part.
The GWT2Energy report breaks down specific advice for multi-site commercial portfolios. Like, imagine you are managing energy budgets for 50 retail stores across 4 different ISO grids.
It is a total minefield of conflicting signals. You have cheap gas telling you to buy and stressed grids telling you to wait.
Exactly.
The report emphasizes that you must define your actual goal this week. This raises an important question you have to ask yourself.
Yeah.
Are you buying to ensure long-term budget certainty so your CFO can sleep at night, or are you trying to day trade the short-term weather market?
Day trading the weather is how businesses absolutely blow up their budgets.
It really is, which is why the report provides a very clear timeline strategy based on how far out you are contracting your energy.
Let's start with the immediate term, 0 to 6 months out.
Okay. The playbook for 0 to 6 months says maintain whatever coverage you absolutely need to keep the lights on, but avoid adding large blocks of electricity during these heat-driven strength periods.
Makes sense. And for gas?
If you are a gas buyer, you can add small incremental tranches if the price pulls back.
Then we move to the sweet spot we discussed earlier, 6 to 18 months.
Right. This is the prime operational window for that measured natural gas layering strategy.
So use the oversupply from the Freeport LNG bottleneck to your advantage here.
Exactly. Lock in your baseline gas budget in slices. For electricity in this time frame, again, do not execute your purchase all at once. Price it out over several weeks.
And what about the long game, the 18 to 36-month window and the Meiji 36-plus-month corporate contracts?
This is where discipline is paramount. For 18 to 36 months, stay highly selective. Only add coverage when the forward pricing directly meets the internal budget objectives you set way back in January.
The report specifically highlights a trap here, though. Do not overcommit solely because the current immediate gas fundamentals are soft.
Yes. Just because the gas EPI is 32 today does not mean you should blindly sign a 3-year contract assuming prices will just stay at the floor.
Because the market will eventually balance.
It always does. And for anything over 36 months out, those massive long-term contracts should be used primarily for strategic hedging. You're basically buying insurance against future volatility. You need a clear, structural reason for your business to lock up capital for 4 years, and you certainly shouldn't be making a 4-year commitment just because you are reacting to a late August heat wave in Texas.
Yeah, tie your contract decisions to your long-term budget objectives and your open portfolio positions, not to hot weather headlines. It is really about separating the noise of the heat wave from the signal of the underlying supply.
Exactly. The specifics of your site locations, your specific utility territory, and when your business actually uses the bulk of its power during the day, those operational realities matter just as much as whether natural gas is sitting at record production levels.
It is a beautifully complex market right now.
It certainly keeps us on our toes.
Just to synthesize the massive amount of data we've decoded today for you,
Right.
we are operating in parallel realities. On one side of the dashboard, we have EIA-backed record gas production, near historic storage caverns just full to the brim, and an export bottleneck creating incredibly favorable long-term fuel buying conditions.
And running parallel to that, we have intense NOAA predicted extreme heat waves, putting severe physical stress on regional grid infrastructure.
Particularly in isolated systems like ERCOT and congested systems like PJM.
Right, which is elevating the near-term financial risk for electricity buyers.
Which means your strategy is discipline layering. Buy the gas weakness in the 6 to 18-month window using tranches, but step back from the electricity market when the heat temporarily spikes the delivery price. Trust the long-term supply over the short-term weather panic.
That is the big takeaway.
We want to thank you for joining us on this deep dive into the August 17th energy landscape. Keep your eye on the dashboard, stick to your layering strategy, and as always, stay curious.
Actually, before we go, there's one final piece of the report sitting quietly at the bottom of the watch list that you should really keep in the back of your mind.
Oh, right, the wild card.
Yeah. We've spent this time talking about how stable our natural gas supply is and how our only real problem is the grid overheating. But imagine a scenario: a late August hurricane enters the Gulf Coast. In 24 hours, that storm knocks out the Freeport LNG recovery, disrupts offshore gas production, and physically tears down the regional transmission lines.
Wow.
Suddenly, a weather-driven electricity issue transforms into a massive nationwide fuel supply crisis. Today's certainty, that beautifully stocked storage cavern of cheap natural gas, is only one major storm away from tomorrow's chaos.